Welcome to the deep dive. Today, we're really digging into Palantir Technologies, PLTR. It's a company that seems to be everywhere, grabbing investors' attention with its, data analytics and these AI platforms.
Absolutely. And for this deep dive, we've gathered some, well, pretty interesting recent material. We're looking at news summaries, financials, analyst takes, mostly from this past week, late May 2025. Some stuff from the Motley Fool, Wedbush in there too.
Right. And our goal here is to unpack what this latest info tells us, about their business momentum, that big push into AI, how the stock's reacting, and importantly, tackle those sometimes tricky questions around its valuation. We want to help you sort through the noise.
Yeah, it's a great time for it because, the sources just keep highlighting how Palantir stock has been on an absolute tear, leading indexes. Yeah. But that brings up the sort of central tension we saw in the commentary. Is it now priced for, well, perfection?
Okay, let's start right there then. This impressive performance, the sources mentioned, a 1,200% rise over 3 years, and leading the NASDAQ 100 this year, up like 63% year-to-date recently. What's actually driving that, according to the reports?
Well, the sources point pretty directly to accelerating momentum in the business itself.
Yeah.
We saw figures showing Q1 2025 was the 7th straight quarter of revenue acceleration, hit $884 million total.
Just a quarter, okay.
Yeah. And what really jumps out is the U.S. market strength, U.S. revenue overall, up 55%. The government side, U.S. government, up 45%. That's about $373 million.
Solid number.
But the U.S. commercial segment, the sources literally described it as being on fire. It was up 71% to $255 million.
On fire. Yeah, that definitely catches your eye. And I saw something about booked total contract value. In U.S. commercial, up 183% in Q1. That seems huge, right? Like future growth locked in.
Oh, absolutely. That's a really strong indicator of the pipeline converting, demand turning into actual deals. And building on that, the company boosted its full year 2025 revenue guidance.
Okay.
They bumped it up to $3.89 billion to $3.9 billion,
right,
which implies, about 36% annual growth? And they specifically said they expect U.S. commercial growth to stay way up there, around 68%.
Wow.
So you've got accelerating revenue. Profits are soaring too. Operating income more than doubled. Non-GAAP net income up 62% in Q1, plus strong guidance. The sources are clear. That's what's fueling the excitement.
Okay, the operational strength seems undeniable then. How much of this, based on what we've read, is tied specifically to their AI platform? AIP, that seems to be the buzzword.
It really is. AIP comes up constantly as a core driver. It's described as like an orchestration tool. It lets companies blend these new large language models with Palantir's existing platforms, Gotham for government, Foundry for commercial data integration.
Right, makes sense.
And management's language was strong. They called demand explosive. It's not just them saying it either. We saw one source mention Forrester Research ranked Palantir as a leader in AML platforms.
Okay, so third-party validation too.
Exactly. And that, plus landing big deals like a $30 million contract with ICE working on NATO AI systems. It suggests the tech, especially AIP, is hitting the mark.
Yeah.
Across lots of different industries, too. Hospitals, pipelines, insurers, telcos.
Yeah.
They were all mentioned.
Okay, so that paints the growth picture, the reason why the stock has run up so much. Yeah. But here's the other shoe dropping, right? Where the sources start flashing warning signs. The valuation, words like stratospheric, nosebleed levels. What numbers did they actually give?
Yeah, this is the big counterpoint. The numbers are pretty stark. The price-to-sales ratio, the PS, it's cited between 96 and about 101.5 times sales.
101 times sales.
Right. And just for context, the S&P 500 average is like 2.8 right now.
Oh, big difference.
Huge. One source put it really sharply. They said Palantir would still be seen as expensive even if its PS ratio was just 24. Which is like a quarter of where it is now.
And to get to that PS of 24.
You'd need revenue to basically quadruple from today's levels just to justify that lower, still arguably expensive valuation.
Wow, okay. And what about earnings? The PE ratio?
Also sky high, cited at 265 times adjusted earnings. Now, earnings are forecast to grow fast, maybe 41% this year, and Palantir does tend to beat forecasts. But still, 265 times earnings, that sets an incredibly high bar. You need almost flawless execution just to keep that multiple, let alone grow into it.
It feels like it's priced for beyond perfection, which leads to the big question the sources raised, is this sustainable? I saw something about a historical look.
Yes, that was fascinating. One analysis looked back 20 years at software stocks. They found only 6 others that hit a PS ratio over 100.
Only 6, okay. And what happened to them?
Well, the outcome wasn't great. All 6 eventually saw huge drops, at least 70% down from their peak. The average decline for those 6 stocks, 81%.
81%. So if you apply that historical average.
Right. If Palantir followed that historical pattern, applying that average 81% drop from its recent peak, well, it suggests a potential downside to a much lower share price. It's a sobering historical comparison presented in the material.
Definitely gives you pause. But, like you said, there's a debate. Not everyone agrees it's doomed, right? Some analysts are still really bullish.
That's right. The sources show that split clearly. You've got analysts like Dan Ives at Wedbush calling it one of the top technology stocks, sticking with a, $140 price target?
High target.
Very. And Morningstar suggested it could be the next software juggernaut. But then you have other analysts sitting at hold, pointing directly at the valuation. The average target price we saw cited was way lower, around $93.89.
Suggesting it's already priced in.
Exactly. That the good news, the growth, it's already reflected, maybe even over-reflected in the current price. It really highlights the tension in the market right now.
So let's try and synthesize this. We've got, from the sources, this picture of really strong business momentum. AI demand is high, U.S. commercial is booming, the tech seems unique. But then there's this just undeniable overhang of an extremely high valuation. What are the key takeaways balancing those two sides?
Well, the strengths are clear from the reports. That accelerating growth, the AIP demand, improving financials, big contract wins, powerful stuff. But the risks are just as clear in the analysis. The valuation requires basically almost perfect execution.
No room for error.
Pretty much. There's the risk of a sharp pullback if they miss a step, or if market sentiment just shifts away from these super high growth names. You always have broader economic risks, and maybe down the line, competition, though that wasn't the main focus. Oh, and one source did flag a possible slowdown in international commercial growth as something to keep an eye on, even though the U.S. is so strong.
Okay, so pulling it all together, what does this mean for you, the listener, trying to make sense of all this information?
Based on what we've reviewed, the business itself looks really well positioned. It's in a hot market, AI, and seems to be executing very well operationally. However, the analyses strongly suggest the current stock price, around 100 times sales, over 260 times earnings, is already factoring in years of future success, maybe assuming perfection. So while some analysts see more upside, that historical data point about other stocks hitting 100x PS offers a pretty strong warning about how sustainable that is. The implication from the more cautious sources is promising company, yes, but the current price tag carries, significant risk according to their numbers. Waiting for a better entry point, maybe a dip is suggested. Though, patience might be tough with all the hype.
It really is fascinating, isn't it? A company firing on all cylinders operationally, getting rave reviews for its tech, yet facing this intense scrutiny and, frankly, some stark historical warnings about its stock price. And that contrast is just really sharp.
It really is. And it leaves you, the listener, with a critical question coming out of this deep dive. Looking at the history of similar software stocks hitting these kinds of valuations, do you see enough in Palantir's story, its tech, its market, its potential, based on these sources, to believe it's truly different this time? That it can defy that historical pattern?
Or is history a potent guide here, suggesting that, at some point, a significant price correction might be more likely than not? It's that classic tension, isn't it? Balancing that exciting growth story against valuation discipline. Something to really chew on.